Okay, today we're going to talk about chapter 4. And so I'm going to use a combo of some of my favorite slides from the PowerPoint and some notes that I made about how to make journal entries. And so I just picked up 12 of the slides that I think are best when I'm doing this title slide. So I'm going to change that to presentation mode and run through those, and then I'll come back and do my journal entry refresher for you. Okay, so the first thing that we'll talk about in this one is we're going to talk about the steps to the flow of the accounting of the financial data. And so basically you have these steps that are very similar to the steps to the steps that you have to make in order to get things recorded in the system. First thing is, it's sort of like we talked about where the steps to the accounting process. And so it starts with you analyze what just happened in the company. And then you make a journal entry to record that entry. So once you've made that journal entry that shows what just happened to our company, what transaction just happened, then you've got a journal entry that's got to record it. So you can just forget about, really for accounting purposes, forget about analyzing the transaction anymore, because once you analyze it thoroughly, a major journal entry is already under control. So then you're going to totally rely on the fact that your journal entry is correct. And you're going to take your journal entry then, and you're going to post it to the general ledger, which also could be the T account, or it could be a columnar general ledger account. But either one, it's going to be an account that tallies each account type, or each account specific account actually, and post those journal entries just so that it can reflect that journal activity on the account and how much it increased or decreased the different accounts that were involved in that journal entry. And so we've got analyze the transaction. Then once you analyze it thoroughly and you understand, you have to be very careful to do it correctly, of course, but once you do analyze it and you know that you're right, you make a recording of it by journal entry. So then you've forgotten all about this analyze step for that transaction, and you just are going to work with your journal entry. So then once you've made your journal entry, you post it to the general ledger or the T accounts. And when you do, once you've posted that journal entry, you forget about that journal entry. You don't go fishing back into, oh, what happened again? Or, oh, what journal entry did I make? Once you've posted it to the general ledger or the T accounts, you leave it at that, and you just work with what's in the general ledger now. And so remember, a T account collection is a general ledger, or a columnar worksheet. If it had the account names in it, the different accounts in it, or a official ledger that has each account name with its activity in it. Though any of those could be considered the general ledger. I personally like to deal with T accounts, so you're probably going to see me presenting T accounts a lot of times, unless I'm showing you a demo that you need to be able to do for your homework. Okay, so a general ledger, now we've got everything that just happened is recorded in our general ledger, so we can just ignore the analyze piece and the journal entry piece. So then from our general ledger, we take each balance and pull them to that total sheet we talked about earlier in an earlier chapter called the trial balance, where it records all the assets, then all the liabilities, then all the equities, then the revenues, then the expenses, and those accounts are all listed there with their balance with an entry either on the debit side or the credit side, but not both, right? So whatever its ending balance is recorded on this one page. I mean, it could go over a page, but generally you think of it as being a page when we're learning, especially. It's just a one-page sheet that shows all the balances with their ending balance at the end of the period, and it shows what the balance was as either a debit or credit, not both. And it's always in this order of assets, liabilities, equity, revenue, expense. And they're also, just as an aside, in order of liquidity for the assets and liabilities, which means for assets, the ones that are cash are first, and the ones that can turn to cash the fastest, that is their liquidity, are presented next. And then for liabilities, liquidity means the ones that are going to come due first are listed first, and then after that, the less current ones as you go along. Okay. All right. So, and then a lot of times revenue expenses are listed as from the largest down or alphabetically. And so the textbook will generally take one approach or the other, but in a problem that it matters greatly what order they're in, like when you're being tested or when you're being graded in Cengage, there will generally be a notation that says list expenses in the in the alphabetical order, or list expenses in order of the highest first. So usually be one of those two though. So that's nothing to worry about in real life, really, as long as you have them in the correct sections. But for these electronically graded things, it does sometimes matter what order you put them in. So be careful and read your directions every time. Okay, so that's basically what this one's talking about. How do we go through the process? And then once you go through each step, you're like ignoring the first ones. So once you get to the trial balance, you're ignoring the general ledger accounts now. Until next time you have to start posting again, you ignore that. And until next time you need a general journal, you ignore that. Till next time you have to analyze a transaction, don't think about analyzing a transaction. When you get to the trial balance position, you're not thinking about any of the transactions you just recorded. You're only thinking about what is the ending balance showing up on the trial balance. Okay. All right. Now, the next thing, there's these source documents that we need to kind of be familiar with. And one example would be like check stubs or copies of checks, or an electronic record that the bank provides you of such, because sometimes we use those now to make recordings. But that would be for cash payments that we make, that we pay. And then on the receipt side, cash receipts that we collect, we would also have receipt stubs for those, maybe copies of the receipts, cash register tapes, memos of the cash register tape. Or you could also have records that were coming from the bank where you had included something with your bank deposit that shows the client's collection. So there's a lot of things that you could be using to either use to record or to cross-reference the records that you're trying to make. And so either way, that these are just some of the source documents you could use. And then for sales and goods, sales of goods and services, you usually would have sales tickets or invoices that you issue to the customer that recorded that sale. A lot of times it would be a contract that you would have, depending on what kind of business it is. There might be a contract that backs up the sale. And so you might have that all collected at the same place, and it could be an electronic record or it could be a printed record, but in any case, you will have some source that ties to the records that you posted for sales. And then for purchases, the same deal. You would have purchase invoices, either printed or electronically collected, and they would tie to the purchases that are recorded in your general ledger. Okay. And then the next thing, and of course, if you look through the PowerPoints and if you look through the chapter, they're going to talk about some more topics. I've taken the highlights and trying to give you the most critical pieces so that you kind of have a feel for it. My lecture should never mean that you don't read the chapter or that you don't go through the PowerPoint that's provided. So I'm just giving you a little meat around the material. Okay. All right. So this is an example of a chart of accounts, because a lot of times a chart of accounts is a big benefit to have in front of you whenever you're trying to make a journal entry, because it helps you to see what accounts has the company been using. Doesn't mean you couldn't make a journal entry, but to record something that you've never recorded before, because sometimes you do have a transaction that's not been on your records before. But a lot of times the chart of account can help you because it's a transaction that happens all the time. So you could look at it and say, what is the account we're using for when we record a revenue? So if you haven't noticed, they change the names of the revenue accounts all the time. It drives me crazy. Why can't they just use the word revenue if they don't have a specific thing they need to track? So I don't know. They didn't ask me. But in any case, all I'm telling you is they could just say revenue or sales revenue, but instead they sometimes use things like professional fees, and it doesn't, or professional fees earned, or like this one, delivery fees. That's the revenue account. And so we have to get comfortable with different names being on this revenue accounts, because it's just some kind of weird thing with accounting. Almost every expense has the word expense in it, not all, but most of them. And so that makes expenses easy to identify. Revenues, on the other hand, we have to realize if it says the word fee or income or revenue or even earned, it might be a revenue account. So be careful with that revenue thing. But you see how the chart of accounts would help me with that? Because I would just look here and say, okay, here's assets, here's liabilities, here's equity, here's revenue, here's expense. There's only one account under revenue. So if I'm having a normal sale and I'm going to record it, I'm going to put to this one revenue account we have. But if it's something extraordinary, different, like I sold a piece of equipment, I sold a piece of land instead of a normal product or service that I provide, then I would need another revenue account for it. And I would just add one. And then my chart of accounts, next time I looked at it, would have a different account. You see how these people numbered them? That's pretty typical. The asset numbers would all start with a certain digit or a certain sequence. And then the liabilities would start with a different number or a different sequence. It could be letters too, but it's probably numbers because numbers are easier for accountants. And then owner's equity would have another set of numbers. So each of the different asset, liability, equity, revenue, expense, each of the different account types would have a different numbering system usually, but they would be similar to one another, but just in a different sequence. So you see that all their assets started with 1, all their liabilities started with 2. That doesn't mean it has to be. That's just their system they did to keep them separate so that when they look at something that's got a account number on it of say 507, they're going to say, oh, that's got to be expense because it starts with a 5. And so that's all that's for. And so this is really, we already understand the rest of this. These types of accounts, cash, accounts receivable, those are all assets, and we already learned that. These expenses, they all say the word expense, thankfully. Those are all expenses. These equity accounts, we already knew those were equity because it says capital and drawing. So it's just reminding us some of the things we already know and adding this account number to it. Okay. And then the journal. This is just a little wordy for me as far as PowerPoint slides go, but hey, I'll try. I'll work with it. A journal is just talking about the record that you keep of what's happening every day. And so it kind of is a way that you can just kind of look at it you need to know something happened. You can't remember when it was. You can go back and look in the journal and it will help you to identify it. Sometimes people call that the book of original entry. The simple journal is a 2-column journal. That's mostly what we learn on. And then sometimes people, especially when they used a manual system, used to use these big journals that were more than 2 columns, and they would actually split the cost out on a sheet, and it would become a worksheet basically. But this, what we're learning how to do when we journalize or make journal entries, is we're learning how to do a 2-column double entry accounting entry. And so for every transaction, we're going to be recording a date. Now, when I'm just casually writing down how to make a journal entry, I don't date it. I don't put an explanation. I just tell you what happened. And then I just put the debit amount, the debit account, the debit amount. The next line, I scoot over a little bit because the credit entries are over to the right slightly from the debit entries. So when I make the entry, I put the debit entry, the account name on the left, and then I put the amount beside it. And then on the next line, if it's just a 2-line entry, I make a credit entry that's indented to the right just slightly. And that's my account name. And then indent again to get my account, my credit amount. And so the credits always indented to the right. Debits flush with the left. Okay. And so for every entry, there's going to be a date. There's going to be each account name, which they're calling a title. And then there's going to be the amount that's being debited or credited and a little description. So I skip the date and description when I'm just teaching you how to make a journal entry. But when you're recording it, you have to put those things because someone's going to want to know, why did you make that entry one day? Someone's want to know, when did you make that entry? So that date and description has to be there in real life. Okay. So now here's an example of a journal entry. And this is a journal sheet, in other words, of multiple entries. So this is our journal page, right? So the first entry, see how they debited. Well, first I'll start where they started, where their description started. The date, see how they had June 16th for the date. That's what date this transaction happened. We bought some supplies. So if you'll notice that the description is almost exactly the same as the description is given to tell you to make a journal entry. So if you have to make descriptions, it's okay just to write the same thing that they said in their descriptive most of the time, or take some excerpt from it. So this time we purchased some supplies for cash. So we have to think about what just happened. We purchased supplies on cash, means we got some supplies, which is an asset, and we paid cash for them, which means one asset increased supplies and one asset decreased cash. So we debit supplies because it increased. We credit cash because it decreased. And that's what this $80 is. Then the next thing that happened was this said, I can hardly read. This is so tiny. I should make it bigger. Accounts receivable and the received cash on account from, oh, it's got the detail. That's what it is, from the library and Sound of Music. Okay, so they got cash from two different clients, which when you're making a journal entry, that doesn't matter. Whenever you're actually recording it, you have to credit to the correct client. But when you're learning how to make a journal entry, you would just say, well, that's going to be a debit to cash because cash just increased, and it's going to be a credit to accounts receivable. And it just happens to be two clients. So it's just still one entry, $1,900 debiting cash and $1,900 crediting accounts receivable. Okay, so you see how that's just examples, but you see these little yellow things they're showing you that when they started to do the credit, they indented over a little bit. So that's why you'll know up here that cash was a credit and supplies was a debit. Cash in the second entry, cash was a debit and accounts receivable was a credit. And you can tell because the accounts receivable is indented like credit entries are. Okay, here's another thing. This is a compound entry. See, it's got 3 accounts that are affected. So what happened here was we purchased a scooter with a down payment. Balance on the account will be due later. So what they got is a compound entry because we bought this piece of equipment. We're going to call it delivery equipment, debit the account for the amount of the purchase for this $1,000, but we only paid down $300. So we're only going to credit cash for $300. The other $700 we're going to count as accounts payable. So we had 3 entries. We had to make an entry to the delivery equipment, to the cash, and to the accounts payable. That is called a compound entry. So, but still it balances. All the debits of that entry have to equal all the credits of that entry. So you see how it's got a debit for $1,000. And when you add the credits of that journal entry together, they equal $1,000 also. So we always keep our balance. That's the accounting equation has to stay in balance, right? So if you threw a journal entry in there that was one-sided, your accounting equation would go off balance. You would not have the same equal amount of debits and credits. So that must be done. Every entry, the debit entries have to equal the credit entries. So normally that's not a problem because there's only one debit, one credit. But if there's multiple debits or multiple credits, you have to make sure that the two sides are equivalent. Okay. All right. So another thing, you see how they all had a date, but when the one started with June 16th, I cannot read that. Yeah, June 16th. Then the next time it was June 20th. But they didn't have to write June again. You could, I would actually, because I don't want confusion, but they don't have to have the month entered there. They could just put the date if it's the same month of the entry they just put in. And that's because if you were doing this manually, you would have lots and lots of entries each day. And so that just saved the person time that was making the entries. When you're doing it on the computer, you actually go ahead and put the full date, of course, even including the year, which this does not show. And that's just because in the computer, if you put the wrong date in, it will move it to that period that you just entered. So if you actually put July 20th, it would be in the July register, a journal list instead of in June. So you have to be careful with that in a computer system more. That's why I'm used to putting the entire date, is because a lot of things are computerized now. But in any case, if you're using a manual system, you could omit the month. And a lot of people omit the year and just keep their journals as this is the 2020 journal or this is the 2022 journal. And so it's just a different world whenever you're on the computer. I mean, it still works the same, but you have to worry about different things whenever you are using the computer. Okay, and so that's really all they taught us in that, but that's a lot of stuff, but it's just make sure that you're understanding how that works. The next thing they show us this general ledger account in a columnar format. And then they show us out the way I like to look at it, which is the T account. You see the T account, it looks like it has a big capital T right in the middle of it. That's because that's how it got named, to be a T account. But these transactions that are recorded in the T account, it's A through O. All these transactions are recorded over here, exactly the same transactions in this columnar ledger. Now, do you see the T account inside the columnar ledger? See this T account right here? It's right there. Now look over here. Isn't the T account right here? The only thing they've done different is they put them in numerical order, I mean, in date order, I guess. And they only put one per line, whereas in a T account, it's not a problem. You could just put one per line on a T account, which I do sometimes do in order to make it clearer to people when they're learning. But if it's not necessary, you can just put all the debits on the left and all the credits on the right, just like we always do and how we learn. And then when you get ready to tally up, you just add all these debits, you add all these credits, and you net it out to put the balance on the side that has the largest balance. Because what happened here is we had 9,900 debits for this period of time, and we had 9,430 credits. So if you look at those two and compare them, the debits win. So the debit is the ending balance. The debits they were like, oh, we're going to build this account up, $9,900 increase that we're making with our debits. So we're going to win because they made less credits than we did debits. So the debit side had added to it 9,900 total by putting in 5,000 debit, 2,100 debit, 1,900 debit, and 900 debit. And then when those credits came along, in other words, on a cash account, it would be payments made, right? They came along and wrote checks and paid expenses. And so these credits started eating up the debit balance. So every time $2,000 credit, that would just lower the balance by 2,000. Then another credit of 600, all the way down to 3,000 credit. So by the time they were through, they had credited the account for 9,430. So what happened is they increased this account with 9,900 debit amounts, dollars. And then that debit balance got eaten up every time they put a credit to it. So before it was over, the credits had eaten up 9,430 of the 9,900. The only thing left was $470 in this debit balance. So 9,900 minus 9,430, that's how you came up to your debit balance. But just think of it as you have this account that's normal balance is debit. And every time a credit is put to that account, it eats up some of the account's balance and it decreases when that happens, of course. And so the only thing the poor little cash account had was $470 at the end. But look over here in the general ledger columnar presentation, it's exactly the same thing. See these debits, 5,000, 2,100, 1,900, 900. Aren't they right here? 5,000, 2,100, 1,900, 900. There's the debit heading. On a T account, you don't see the word debit over there, do you? But don't we all know that this debit side is debits? And we all know that the right side is credits. I don't even think of it as right and left. I think of debit and credit side. But anyway, so when you get to the columnar presentation of same, it is still there. It is just that they have the word debit and credit at the top, and they separated each one of them into one line each by date. So this is June 1st, June 3rd, June 6th. So they just have given it one line. And then the other thing they did, they added this little part over here that is an ongoing balance. So if this account had been coming in from a previous month, a permanent account, it would have been, unless this is their first month of operation, then they would have a beginning balance also. This one doesn't show a beginning balance, so this must have been their first month. So this first transaction of $5,000 is what started the account. And then when they had a check written, well, we won't even think about it like that. We're going to think of it as this is a balance. It doesn't even matter if it's cash or any account. It starts out with a balance, probably. If it didn't, then it starts with the first transaction. So 5,000, it's a debit. Then we make an entry, a credit to it. That decreases the 5,000 because it ate up a piece of it down to 3,000. So the balance is 3,000 now. Then another 600, that brought the balance down to 2,400. So this is just a cumulative balance as you go along, a running balance of the account over here in this. It could go in the credit column and have a balance, but you know what that would mean. For our cash account, that would mean we were overdrawn. So we hope we never see anything in the credit column in this textbook or in our business, right? Probably one in the textbook. Can't really promise you that in the business because sometimes businesses do go overdrawn and they just have to correct it by making a deposit. Usually it's because of some kind of error on the part of the accountant. Sorry about that. Okay, here goes another one. This is when we post from the general ledger over to the from the general journal over to the general ledger. And really, I don't have to show you that because you know how to post entries. Well, I'm sorry, if you don't know how to post entries, let me talk to you about the fact that it's all you're doing is taking the actual transaction that's happening in the journal entry and posting it to the account that relates to it. So that cash account would have a T account or a columnar a columnar register account like this, a ledger account, basically, columnar ledger. There's a lot of terms people use, and that's why I'm confused about it, about what to call it. I'm not confused about what we do. We take the journal entry, we post to the cash account a debit of $5,000 in this case. And so if it's a ledger, like this columnar presentation with the cumulative balance, then we would just post that debit as a debit. We would never switch it or try to figure out whether to put it as a debit or credit. We'd look at the journal entry. We look up here, we say, oh, it was posted as a debit. That means I have no choice. I have to go to that very account, cash, and I have to post it as that very thing, a debit for that very amount. So I don't go analyzing the transaction. I don't go thinking back to what just happened. I look at the journal entry and I post it to the T account, and that's it. And the T account or the general ledger columnar presentation, same thing. So I'm posting it, and then I go to my credit entry and I find its general ledger account and I post that credit of $5,000 to the capital account the same way. I don't even debate about where to put it. There's no analysis needed. All it is look at this entry, post it where it goes. Very methodical. Okay. All right. Now, once I've done all the posting, then I look at each of the accounts would have recorded all the transactions that just happened, and they would have a T account for each one of them, or a ledger account in a columnar presentation, but they would still be tracked, and every transaction would have been posted to bring us to an ending balance. And those ending balances we would pull and post in our trial balance, just like we talked about earlier. The cash account, when we just were playing with it, we saw the cash account in a T account at a $470 debit balance. All we would do is look at the balances in the ledger, whether it's T accounts or whether it's that columnar presentation of such, the same deal. The last balance of the period, we would pull the balance and bring it over here to the trial balance as either a debit or credit, but not both. So if I have a debit balance in cash, that means nothing needs to go in the credit side. Now, some programs like Cengage, some people set it up, the question writer set it up to put a 0 in that field instead of nothing. But in actuality, it should say nothing. So if Cengage wants you to put 0 in the opposite column, that will be fine. But if they don't ask for a 0 over there, just leave it blank. Same thing. You got all the different accounts. You see how they got all the assets listed, and they're in order of liquidity, meaning how fast could I turn that asset into cash? Accounts receivable is very fast because it's going to come in usually within a month or two. And then supplies is going to be used up within a month or two. And prepaid insurance is going to become insurance expense within a month or two, or within a year for sure. And then delivery equipment is a longer term asset. Then you got the liability accounts payable. And then you have the capital accounts, the capital account being the equity account, sorry, and the capital one being first, then the drawing account. And then you have your revenue accounts, followed by the expense accounts. You notice that revenue account is a credit balance account because that's its normal balance. It shows up as a credit with nothing in the debit. So every account, just put its ending balance, whatever it is, a debit or credit, and be sure to put it in the right place. And then when you do, you're going to tally all the debits and put a number at the bottom. Then you're going to tally all the credits and put a number at the bottom. And if they're the same number, you're going to congratulate yourself and say, I am probably right. This is what a trial balance is for. So if you're equal, you can congratulate yourself and think, oh, this is good. I think I got this perfect. But there is still a possibility they could be wrong, but it's not very likely. But if those two balances are not the same, then we have to think. If it balances, we have to be careful and make sure we did post them in the right place, because it still could have an entry that was wrong that just got posted. Both parts of the entry got posted, but in the wrong place. But it's just not as likely that happened. But you do need to look at those and be careful. But there's sometimes when it does not balance. And that's where I'm going to give you some tips. The textbook did this, and I think it's great. So I pulled them as part of my favorites for this chapter. What you do is you double check and see if they bounce. And if they don't balance, then you're going to see what the difference is between the debit side and the credit side. Sometimes you can just find where you missed a posting of that amount. And so you posted the debit, but you forgot to post the credit. And so you just go back and re-add and put in your new number. And so that's very common. Then the next step, if that didn't identify the problem, is divide the difference between the debits and credits by 2. If you find that that number, once you divide it by 2, is one of your account balances, then it's most probable that you either put it on the wrong side or you added it in twice. And so it's just an add error usually, or it's a pull error where you put it on the debit side, but it should have been on the credit side. So that dividing it by 2 catches a lot of problems if you don't balance. And then the next one, this is a big one. What you could do if you couldn't identify it by just seeing how much it was different between one another, or just dividing that number, it was different by 2, then the next step would be take the difference of the imbalance, trial balance, divide it by 9. Because if you divide it by 9, it might identify that you made one of these 2 types of errors. There's a slide error or transposition error. A slide error is where you were trying to post one number, but you dropped a digit somewhere in the thing. So usually it's the last digit gets dropped. If you take, it didn't have to be though, a slide. Well, that's not that it was recorded as 25, then the difference is going to be 9/10 of it. So dividing the difference between debits and credits by 9 would identify if you had just dropped the last digit like that. So then it could be some other digit you dropped, but the one that it would identify at the slide error would be, by dividing by 9, would be this drop in the last 0. All right, and then the next one, a transposition error. You're supposed to put in one number and you reverse the digits. Then what could happen is if you take the difference between those 2 numbers, like in this example, 250 was the number, but you accidentally recorded 520, take the difference between them and divide it by 9, and you come up with 30. So if, let's see, I'm sorry, I got to move this so I can see what that difference is evenly divisible by 9. And that's what's telling you that it's probably transposition. It's not that it's 30, it's that it's divisible by 9. Okay, so let's see, get this back down here where it belongs. That's the end of the slides. So let me go ahead and see if I can get out of there. I'm going to change my share. And I'm going to share a different one. This is just some notes I made. I'm going to share this time. Okay, you might remember that we learned this already. This is just the normal balances. I hope you remember. I say you might, like I'm not sure you do, but I'm sure you remember. I should have said that. Assets have a normal balance, which means they increase with a debit. Liabilities increase with a credit, which means they have a normal balance of credit. And then the equity accounts, the ones that increase equity, have a normal balance of credit, which is the capital accounts and the revenue accounts. And those increase with a credit, and their normal balance is a credit because of that. And then the 2 accounts types that decrease equity are expenses and drawing. And so both of those increase with the debit, and they also have a normal balance of debit, because whatever side it increases by is its normal balance. All right, and then here's just another explanation for the trial balance. It's just a listing of the accounts with their ending balance for the period, and it's presented in order of liquidity: assets, liabilities, and equity, then capital, which includes capital, drawing, revenue, expenses. A lot of people think of equity as just the capital and drawing accounts, and that is true. If you have the other accounts listed too as options, revenue and expenses, but if you had to put revenue and expenses in one of the 3, asset, liability, or equity, you would have to put them in equity, because at the end of the period, those assets, those revenue and expenses just get dumped into the equity accounts at the end of the period, and then restart to track the revenue expenses for the new period. And we'll get to that later on when we start talking about closing. Here's just a few accounts, a few journal entries that you might make when you do different transactions. First is if you issued stock, you would debit cash because cash is increasing, and you would credit common stock. So that would be if it's a corporation doing that. If it's a proprietorship, like we're talking about in this textbook, it would be if you an owner bought into the company, then you would debit cash for the amount of money they paid for their share, and then you would credit their capital account. And then if you borrowed money from the bank, you would debit cash and credit note payable, because when you borrow money from the bank, they give you a lump sum balance that you're borrowing. You put that in your bank account and debit cash. And at the same time, you record the fact that you have to pay them back with a credit to notes payable. And again, you see that these two are classic, increasing an asset account and increasing a liability account at the same time. When you borrow money, you're increasing the cash account, but you're also increasing the liabilities that you owe to others. So that's what this notes payable is. That's why it's crediting notes payable. It's increasing the liability called notes payable. If you purchase equipment for cash, then that means you debit equipment, you credit cash, because one asset is increasing, the equipment account, and the other asset is decreasing because you just paid for that equipment with cash. So cash is decreasing, and that's why it's credited. So then you purchase supplies for cash, same thing. And assets increasing is supplies. So we're debiting supplies. Then the other asset, cash, is decreasing, and we're going to credit the cash account because it's decreasing. All right. If you purchase supplies on credit, or also known as on account, then you would have an asset increasing still, because we're still getting new supplies and adding them to our asset list. And that would be a debit to supplies for the $5,000 we're paying for them. But instead of crediting cash, we didn't pay for them yet. If we bought them on account, that means we're going to credit accounts payable. And that is a liability account. So we would credit it. A liability account increasing is always a credit. So that just it agrees with our rules that we have. Okay. If you make a payment on an account that you owe the supplier, then that means your cash is decreased. So you're going to decrease cash by crediting the account for $2,000. And then you're going to record the decrease in the accounts payable too. When you make a payment, your balance you owe to that vendor is going to be, or supplier is going to be $2,000 less. So you decrease the accounts payable by debiting the account, because the normal balance for that accounts payable is credit. When we created the payable, showing that we owed them, we credited the account. Now, when we pay back some of the amount we owe, it means we're going to debit it to show the decrease in the amount that's due. Okay, here's some more, a few that relate to the income statement now. If you billed customers for services, you would debit the accounts receivable, because if we say we billed customers, it means we didn't get the money yet. We're going to wait for them, maybe make them pay next month by the end of the month. So that would be an accounts receivable. That's an asset. So we increase an accounts receivable. It means we debit that account. And then we credit the revenue account related to it. You notice I named it service revenue instead of fees earned or professional fees or services. Sometimes it says service fees, but it could say the word fees or revenue or sales, and it would still always be a revenue account when it said that. The only time, if it says the word revenue in it, the only time it's not actually revenue if it also has the word unearned, because that's a weird type of liability that's not ready to be recognized yet. So we haven't gotten quite there yet. We will get there pretty soon, though, in another lecture. All right, so this one, the next one, we collect some of the cash from the account, from the customers on account. So that if we collect cash, that means cash is increasing. We debit cash for that amount, and then we credit the receivable account to track the fact that it's not all due anymore. So we aren't going to receive all of it. We just got 19,000 of it right now. So we only, like if it was just this one transaction, it's 22,000, we would only have 3,000 left in our accounts receivable balance after these two transactions, right? All right, then if we incurred and paid the utility bills, and it was for this current month, that would mean we call it a debit to utility expense, and we'd credit, that would be a debit. Then we would credit the cash account because cash was going out to pay the bill, $2,500. All right, then if we incurred advertising costs, but we didn't pay them, and the way I know we didn't is because it didn't say the word paid, it said on account. So it's not going to be a credit to cash, it's going to be a credit to accounts payable. If I had paid cash for this same transaction, it would say advertising expense debit, because all the expenses increase with a debit. And it would say cash credit if I'd paid cash. But this time it's going to say advertising expense because I'm increasing an expense. And it's going to credit, that's going to be the debit. And then the credit's going to be to accounts payable for $1,200. That reflects the fact that we still owe this advertising cost. So then we paid employees for this current week's work. That means it's an expense because it's salaries expense. So we debit that expense. Always, if it says the word expense, you're going to record it with a debit. And then we paid it. So that's the word paid is telling you the cash went out. So you credit cash $3,500. So the balance, the accounts are always in balance for every entry. Remember, the same amount of debits as you credit. And then we paid a balance due for the advertising that we had purchased earlier. And so when we pay it, cash is going to decrease. So cash gets the credit. So every time you're making a journal entry, think of it like the most concrete way that you think of when you're analyzing what just happened. Do that piece of the entry first, even if you just scratch it down on a piece of paper. If you're working on a computer, you don't have to enter it first, but you could just write down, okay, what just happened? Cash took a credit because cash decreased. I knew that part. That was more secure in my head, but maybe you know the other half of it better because it says cash paid. And here's the tricky part. It says cash paid for advertising expense. There's a temptation because you saw advertising expense to say, oh, I'm a debit advertising expense, but it's not right. If you read the rest of it, it says paid balance due for advertising expenses that were purchased on account. Oh, we've already recorded this. So that means we paid down the accounts payable. So we're going to record it with a debit to accounts payable, which reflects a decrease in the accounts payable. And we're going to credit the cash again. But I already knew that because I did that part first. So I'm going to debit accounts payable, credit cash. Then if we paid the rent for next month, not this month, then it's not actually rent expense. It only would be rent expense if we paid on the first day of this month and it was for this current month. So you know how landlords won't really let you pay your rent after you've used the property. They want the money in advance, just like insurance people want the money in advance. So that's why you see rent showing up as prepaid rent and insurance showing up as prepaid rent, prepaid insurance, sorry. And that's because they want their money up front and it's not time for us to show it as an expense yet unless it's for the current month. So this time we know they said paid rent for next month. So we're going to record that with a debit to an account called prepaid rent. If it had been for the current month, we would call it rent expense, but we can't do that because it's not time to record it yet as expense. So we have to put it somewhere. We show that it's an asset paid in advance for next month. We call it prepaid rent. It's an asset, debit $2,000. Then the part we knew better than that we could have recorded first was we paid something. That means every time you see the word paid, you say, oh, it's going to be a credit to cash. So that was debit, prepaid rent, credit, cash. Okay. So that's just an example of some entries that might help you as you go along. We'll do another video that talks about the problems that are like your homework.